All right, today we are going to talk about Roth and traditional IRAs. Now, there are other IRAs. There's something called a SEP IRA. There's a simple IRA. Those are through employers typically or for self-employed people. So we're going to talk here about the two types of IRAs that as individuals people have access to, depending on your income. Check income limits, of course. Both of these are retirement accounts. The point of these accounts is to keep building up the amount of money that is in them until you are at least 59 and a half years old. There are important differences between a Roth and a traditional IRA. Let's start with the Roth. And one of the biggest difference is tax implications. Okay. With the Roth IRA, you are contributing what are called after tax dollars. Okay. This means you earn money, you pay taxes on it, then you put the money in the IRA. The advantage to the Roth IRA is that the withdrawals after age 59 and a half are tax and penalty free. Okay, tax and penalty free after 59 and a half. So if you have growth in your Roth IRA, and we'll look at some numbers in a moment, you imagine you put in over the years 80 grand and it becomes 240 grand, that $160,000 you make, you can then withdraw in retirement without paying any more taxes on it. You paid income tax on it in the years that you earned the money you put in. You don't get a tax deduction, but then it grows and is available to you without taxes on the gains. The traditional IRA is basically the opposite. You're putting in pre-tax dollars. This means that it lowers what's called your adjusted gross income. So to really visualize this, imagine that you make $50,000, but you put $6,000 in the IRA. You are taxed as if you had made $44,000. Okay, so lowers taxes now. Very important. But when you become 59 and a half or older and start withdrawing the money, it is taxed at income then. Taxed at income in retirement. So what's the bet, right? What's the bet here? Well, one of the bets that you're essentially making is, when is my tax rate going to be higher? Is my tax rate higher now than in retirement? In which case I would rather get the deduction now and pay lower income tax in retirement. Or is my tax rate expected to be higher in retirement, where I don't really care about losing out on the deduction for my contributions, but I really want to be able to use and withdraw the money in a tax-free way? It's a predictive question. Now, there's another perspective on, generally speaking, the question of taxes. There is an approach. And guys, by the way, a lot of you are going to say, David, how are you a socialist and you're telling people how to evade taxes? No. I'm not a socialist. And I believe, as someone whose political views are that we should tax the rich more, I believe that no matter our income, we have no responsibility or obligation to pay any more than the actual taxes legally due. Even if I think that as a matter of policy, taxes should be different, I don't think that as a matter of habit, people should pay more taxes than what they are legally required to pay. So one of the ideas from the world of taxation is the laws in the future may change. So if I can avoid a tax today, and yes, in retirement, I'll have to then pay tax. Well, those rules may change between now and retirement. This is just one school of thought. That school of thought, avoid a known tax today, figure out the tax in the future later, points to the traditional IRA, right? The traditional IRA lets you save money on taxes today. But David, sir, then you'll have to pay taxes when you retire. Okay, but something might change between now and when I retire, and I might get some benefit in the future in these accounts. You don't know, okay? Not necessarily likely, but you don't know. Let's look at some examples here. And in fact, I have a calculator here. So here's a situation where you put in your $6,000 for 30 years, 6 grand a year for 30 years. Okay. You start with, and let me move this actually, make it a little bit more. There we go. You put 6 grand, you start with 6 grand, you put in 6 grand a year, you get a 7% rate of return for 30 years. That investment will be worth $612,000 after 30 years of growth. Now, you've only contributed $180,000. $426,000 of that total account is going to be interest. It's going to be interest. So the important thing here is that when you think about taxation, you're in a traditional IRA, you are getting a deduction on the $180,000 that you contribute all along, right? So whatever your tax rate is multiplied by $180,000, that's what you save all along. But then as you take distributions out of the 426, you're going to pay taxes on that. Okay. In the Roth IRA, you get no deduction for the 180, which is your contribution. But then you will be able to withdraw the 426,000, whatever parts of it you want, and not pay taxes at that point in time. Okay. So these are the calculations. This is basically the gist of it. A couple other things that are good to know about IRAs. You can put your 6,000 all in one account, or you could have multiple IRAs. You could put 3,000 in one account and 3,000 in another. But the limit is $6,000 across Roth and traditional. You can contribute for the previous year all the way up until tax day. So for example, if the year is 2022, you actually can contribute under your 2022 taxes all the way up until April 15th, 2023, or whatever tax day actually works out to be. And for a traditional IRA, there are no income limits to contribute, but the amount you can defer taxes on phases out between $68,000 and $78,000 in income if you are covered also by an employer retirement account. For a Roth, if the amount you can contribute goes down when you get to $129,000 in income as a single person and phases out completely at 144. If you make over 144,000 a year, you can't contribute to a Roth. There's something called a backdoor Roth loophole. I kind of hesitate to use the word loophole. It's for a future video, something you can look up. Last thing, again, when can you get the money out? Generally, these are accounts for money you don't want to touch until you're 59 and a half. At that point, there are no penalties. Depending on whether it's a Roth or traditional, you might have to pay taxes on the money. Okay. If you withdraw early from a traditional IRA, you're taxed at your ordinary income level at that time, plus a 10% penalty. The penalty can be waived if it's for a first-time home purchase, up to $10,000, qualified education expenses, birth or adoption expenses, and sometimes other things. That's not advice. Consult with an accountant. And you can withdraw contributions from a Roth IRA anytime without taxes or penalties, but the earnings could be subject to penalties or taxes depending on your particular situation. These are the most common retirement accounts for individuals. There are all sorts of different exceptions, caveats, and things to know, but the most important thing, I think, is understanding the tax treatment. Roth IRA, no benefit now on your taxes, benefit later. Traditional IRA, benefit now, you pay taxes later. Very important difference to consider.